Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of tax hacks every investor should know to maximize profits. Implementing tax loss harvesting strategies. Tax loss harvesting is one of the smartest ways to reduce your tax bill as an investor. By strategically selling underperforming investments, you can use the losses to offset taxable gains and even regular income up to a certain limit. Let's break it down step by step and focus on what you need to know to make this work for you. Identifying opportunities for tax loss harvesting. The first step in tax loss harvesting is spotting the right assets in your portfolio. Not every loss is worth acting on, so you need a game plan. Here's how to identify opportunities. Review performance regularly. Look at your portfolio at least a couple of times a year to identify investments that are underperforming compared to their benchmarks or your expectations. These could be individual stocks, ETFs, or mutual funds. Focus on long-term losers, not short-term noise. Avoid knee-jerk reactions to short-term market shifts. Instead, focus on assets that have consistently lagged for at least several months, indicating they might no longer align with your strategy. Prioritize high-impact losses. Losses in taxable accounts have a greater impact than those in tax-advantaged accounts like IRAs or 401ks, where gains and losses don't trigger immediate tax consequences. Consider investment goals. Ask yourself, does this asset still fit my overall strategy? If it doesn't, it may be a good candidate for tax loss harvesting. While no one likes seeing losses, think of them as hidden tax savings. Those losses can help offset gains from better performing investments, putting money back in your pocket when taxes are due. Avoiding the wash sale rule. Tax loss harvesting comes with a key rule, the wash sale rule. If you don't follow it, your losses won't count for tax purposes, which can cost you significant savings. But what is this rule, and how do you avoid it? Here's how the wash sale rule works. If you sell an asset at a loss and buy it, or something, substantially identical, within 30 days before or after the sale, the IRS disallows the loss. Essentially, you can't sell an investment just for the tax benefit and then immediately buy it back. To ensure compliance, avoid identical investments. Don't repurchase the exact same stock, ETF, or mutual fund for at least 30 days. Choose alternatives. If you want to stay invested in that sector or strategy, consider buying a similar investment that isn't substantially identical. For example, you could sell one tech ETF and buy a different tech ETF with a slightly different portfolio makeup. Swap individual stocks for an ETF covering the same industry. Track dates meticulously. Keep track of your trade dates to avoid accidentally triggering a wash sale. Mark your calendar or use tax software to flag potential violations. Think of it this way. The wash sale rule exists to prevent you from doubling up on tax benefits while keeping your portfolio essentially unchanged. By planning ahead, you can sidestep the rule while staying invested. Timing your harvesting attempts. When is the best time to implement tax loss harvesting? Timing matters because taxes are calculated on an annual basis, but market conditions can also play a role. Here are a few tips to guide your timing. Year-end reviews. The most common time to harvest losses is in November or December, as you review your portfolio for year-end tax planning. Harvesting losses before December 31st ensures they count for that tax year. Opportunistic harvesting. You don't have to wait until the end of the year. If there's a market downturn mid-year, you may want to proactively harvest losses. Why? Markets can bounce back quickly, and waiting could cause you to miss out on eligible losses. Coordinate with gains. If you've already realized significant gains earlier in the year, say, by selling a winning stock or cashing out of a property investment, it's a good time to look for losses to offset those gains. Avoid unnecessary churn. Keep in mind, not every loss needs to be harvested. If there's no pressing tax liability to offset, it might make sense to hang on to investments that could still recover value over time. By being thoughtful about timing, you can optimize your taxes without overcomplicating your investment strategy. Tax loss harvesting is a practical way to turn investment losses into real savings. By identifying the right opportunities, following the wash sale rule, and timing your moves strategically, you can take full advantage of this approach. Keep these tips handy as you look for ways to reduce your tax liability without sacrificing your financial goals. Maximizing deductions and credits for investors. Taxes can feel overwhelming, especially when you're navigating the complex world of investments. But understanding how to maximize deductions and credits can lighten the load. Investors often miss opportunities to save money simply because they're unaware of the options available. Let's explore some key areas where you can reduce your tax bill and keep more of your returns. Deductions for investment expenses. Did you know some of the costs tied to managing your portfolio might be deductible? While the 2017 Tax Cuts and Jobs Act limited some deductions for individual investors, active traders and certain professionals may still qualify for valuable tax breaks. Here are a few expenses that could be eligible. Advisory and management fees. If you're paying a financial advisor or portfolio manager to manage your investments, their fees might be deductible if you're an active trader or a professional investor. Accounting or tax preparation fees. Investors with complex returns often hire professionals to prepare their taxes. These fees can be partially deductible if they specifically relate to your investments. Home office expenses. Are you an active investor who manages trades from a dedicated home office? You may qualify for a deduction, but you'll need to prove your home office is used exclusively for investment activities. Think desk, internet service, a separate phone line, all could add up to significant savings. Pro tip: keep detailed records of all expenses and consult a tax professional to determine if you meet the IRS's requirements. Missing out on these deductions could leave money on the table. Foreign tax credit. If you're investing internationally, you may be paying foreign taxes on dividends, interest, or gains. Fortunately, the U.S. offers a foreign tax credit to ensure you're not double taxed on those earnings. Here's how it works. You can claim a dollar-for-dollar credit against your U.S. taxes for taxes paid to foreign governments, reducing your overall tax burden. This credit applies to various types of foreign income, like earnings from international stocks, ETFs, or mutual funds. Prefer a simpler approach? Instead of the credit, you can deduct foreign taxes paid as an itemized deduction, but credits often provide a bigger benefit. To claim the foreign tax credit, you'll need to file Form 1116 with your tax return. While it can seem intimidating, most brokerages provide year-end tax documents detailing foreign taxes paid, making the process much easier. Avoid overpaying. If international investments are part of your strategy, this credit is a great way to avoid being taxed twice, once by the foreign country and again by Uncle Sam. Deductible losses on unrecoverable loans or investments. Not all investments pan out, but losing money doesn't always mean taking a total hit. In some cases, unrecoverable investments or bad loans can provide relief at tax time. Here are some scenarios where this might apply. Unrecoverable loans. Did you lend money to a friend or company that defaulted? If the loan was intended to generate income and you can prove it's entirely worthless, you may claim the amount as a bad debt loss. This counts as a short-term capital loss and can offset other gains. Losses on failed investments. Investments going bankrupt or becoming worthless can also be deducted. For example, if a company you invested in files for bankruptcy, the IRS allows you to write off the cost as a capital loss. Security losses. If you invested in securities that became completely worthless during the year, you can claim the loss, but timing matters. The IRS requires the loss to be claimed in the same year the security became worthless. To report these losses, you'll need to file Form 8949 when reporting capital transactions. Keep in mind, claiming something as a bad debt or worthless security requires proper documentation. Maintain records to clearly demonstrate the investment or loan has no recoverable value. While no one enjoys seeing an investment fail, knowing how to handle these losses can soften the blow. Think of it as turning lemons into lemonade. Even bad investments can help reduce your tax liability. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.